I believe AI is way more than just a bubble. But just in case, we're going to prepare ourselves and find stocks that are immune to this said bubble. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy Blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host today, Véronique, and we are going to talk about a topic that has been a growing passion for me for the past 2 years.
Right.
I'm hesitating to use the word obsession these days. But anyways,
you could.
I could, right? I'm that annoying now?
Well, actually, you sold me to it, basically, because I was really reluctant at first, but you were right, Mike. It does help a lot for small businesses like us, at least. So, for the fun, I just went back in our episodes and thought that the first time that we talked about AI, you're right, it was 2 years ago in 2023, almost 3 now.
Almost 3 years now, right?
Right?
Kind of crazy.
So it's been a few years already, and it has been a big trend since, to the point that many investors are afraid of an upcoming bubble. This is why we wanted to talk about tech stocks that are immune to it, just in case, like you've said, and also why they are immune to the AI bubble should it happen.
Yeah, because on the one side, it is becoming a transformational phenomenon, and we're going to talk about that. But on the other, a lot of investors are thinking, well, if it goes up, it must goes down. And at one point, it is kind of scary. Like some point are just like, yeah, there are stocks that are going up and up and up. And there is something that I realized not too long ago after doing like some analysis about a different industry is sometimes you look at all the financial metrics and they're all going up. So that kind of like justify the P ratio, or the P ratio doesn't look that high, for example, from a valuation standpoint, or if you're using like cash flow growth expectation or whatever models you're using, if you look at the past 2, 3, 4, 5 years and it's all growing double digit, you may be thinking, well, it's all good. It's normal to pay that price today, and you're not paying like 500 times the earnings. But in reality, there's a context where while those numbers are growing for now, but not forever, pretty much the same way that if you look at how many turkeys are being sold in December for Christmas, you probably cannot use this metric to expand your sales in January, February, and March. I doubt that you're going to sell that many turkeys or growing that at that pace once you're in March. So we have to be careful about those growing metrics as well, because sometimes we can hit a stop very fast.
Right. So Mike, let's start by mentioning that AI was part of your investment themes for 2026. We recently hosted a full webinar on these themes, so listeners can watch the replay for free now at thedividendguyblog.com/replay. What will they find in it?
Jam-packed webinar. I mean, it's actually possible that you registered for the live event and you could not go in because the live event is limited to 500 people, and we got way more than 1,000 new attendees. So that was kind of a bit crazy. So what was inside, and now you can watch the replay at any time. It paused whenever you want, so that's probably easier for you. So I discussed major investment themes. The AI is obviously part of it, but there's a lot more to that. Strategies on how to deploy your investment, your cash on the side, and how to view what are going to be interesting plays for the year to come. Of course, I also talk about my favorite picks, but in different categories. So we're talking about hidden gems, we're talking about income stocks, we're talking about dividend growers, we're talking about defensive plays. There's something for everyone. And inside of it, there's also a private webinar invitation for
Mhm.
DSR members only. So if you do not become a DSR member, you will not have access to this. But I'm going to do a portfolio reset workshop to help you identify your weaknesses in your portfolio and then having a clear investing strategy for 2026. And you're going to leave this workshop with a 90-day action plan. So everything you need to get out of that classic hesitation, analysis by paralysis, and then you're going to start taking action after this workshop. But this is only for DSR members. It's going to come at the beginning of February, and I'm talking about this in the webinar as well.
Right. So, Mike, for the benefit of today's episode, you know what? Wait a second. I'll just repeat the link because I think it's important. So, thedividendguyblog.com/replay to get the replay of this amazing webinar and maybe get access to the portfolio reset workshop that I can't wait to attend myself. Okay, so for the benefit of today's episode, Mike, please summarize how the AI trend has evolved in 2025, making more people afraid of a bubble.
One word, fast. It was like very, very fast. I know a lot of people are still using ChatGPT for simple questions. They get frustrated with the answer because it needs to be nurtured a little bit more. And even that was my experience with my wife trying to convince. Yes, I'm trying to convince everyone around me to use AI. Fortunately, my son William is on my team, so we're we're working together. But of course, it's a lot more than that. Actually, when you look at a lot of industries in the US where you have people, they come out of their bachelor degree with debt and they're trying to get a junior job in their field and they have a hard time to find one because a lot of companies now, and I include myself, I mean, we're like a very smaller scale here, but now anytime that I would need a junior to do a task, I don't have to hire someone. It's going to be
Mhm.
handled by AI and how I've shaped it. And we have seen this a lot more in the US. I've listened to a few podcasts from the Wall Street Journal talking about this issue as well. So it's just everywhere. I mean, just to give you a couple of ideas of what you can do with AI for some who are a bit reluctant to try it. Well, last year I used it to plan all my trips to find the best deals for flights, best deal for hotels, best neighborhood to stay. I did it also to plan my entire renovation, and we're talking about a full kitchen and two full bathroom. And once now that it's done, that I survived, I can tell you that I barely did no mistakes, and everything was done with the help of a professional designer called ChatGPT. That's kind of crazy, but that's how it goes. And it was just incredibly well done. I revised my financial plan and I use it to bounce back ideas to get challenged, and it works incredibly well. I've obviously automated a lot of tasks in the business, and it's only the beginning, actually, from what I can see. We're actually working right now on building a Mike AI for our DSR members where we will have all the knowledge, everything. Can you imagine we can package all those podcasts that we've been doing for like 5 years now? The Moose on the Loose, the YouTube channel, the 50 newsletter that I write every year for the past 13 years will be in this AI to know how to address any type of investment analysis, any portfolio management problems, so many things that are possible now. So back to the bubble, because of course we get all excited about this and it's fun, but the big problem here is actually it's a two-side problem, and we're going to talk about it later on today as well. On one side we have valuation, of course, because we look at the Magnificent Seven, we look at other AI stocks, and I mean, you have to pay a steep price, usually more than 30 times the earnings to get access to those kind of stock. So you may be thinking, well, at one point they're kind of priced for perfection, so if they fail to generate enough growth, meaning like 20% growth will not be sufficient and will push a stock down 10% if they report 20% growth on something. So that is one part of the problem. Another part of the problem is it's great, but a lot of companies are spending way too much money and it's not necessarily profitable. I'm thinking about
Mhm.
OpenAI, where all the reports, all the analyst calls that I hear is they are not able to find a moment where they're going to be profitable. Yes, their revenues are growing super fast, but they're spending a lot more. So
Mhm.
it's kind of becoming a problem because all of those usage are great, but if there's no money at the end of the road, investors are going to eventually leave that boat. And when they do, well, that's the plain definition of a bubble. Everyone realized that the narrative was a lot more interesting and exciting than the real numbers. But when you look at the bank account, the money's not there. At
Mhm.
one point, you're going to pull out the plug, and that is one of the big risks around artificial intelligence right now.
Right. And I mean, some of them may be the next Amazon, but some of them may also be the next BlackBerry, right? So
Yeah, totally. And we may also, in some cases, we may be thinking that we may overstate the productivity gains. So
Mhm.
first we may say, "Oh, it's amazing. I'm going to save so much time." But if you look at all the moment that you need to work on nurturing the AI and building your system and the
Yeah.
output and the time that you really save, maybe it's not going to be that incredible. And anyway, like any other trends, sometimes it's true, sometimes not so much.
So we will discuss the four companies shortly, listeners, but I think it's important to really understand the context first. And the truth is that there are differences between the dot-com bubble in the early 2000s, which is what people often refer to when they talk about AI bubble, and the current, let's say, AI wave, right?
I like that. Well, first, of course, there is a dot-com feeling here. And now we have to go back to that story first to understand what's happening now. So back then, there were two major elements that explained the bubble. The first one was the classic Vero.com, Mike.com company that has like only page views and clicks and then nothing to show for. And eventually that was a bust. There's another part of the bubble that was even more important, actually, is the massive investment in the internet infrastructure. So a
Mhm.
lot of telcos, they invested billions of dollars to build the backbone of the internet, which we're still using today. So that was a
Right.
smart investment. But the problem was a lot more, like too much money too fast and not able to get money back. So Cisco was one of the poster boy back then. The PE ratio was above 100 at one point, and it was just crazy. And I saw the headlines. I think they recently like break that record not too long ago in terms of like stock price, but it took them forever to come back. Another example, and it's kind of ironic because I will label, shocker alert, I will label Microsoft as being kind of immune to AI, but more like resistant, I would say. But back then it was trading at 75 times its earnings. And also Microsoft went into this desert path of like more than a decade where revenue was growing, earnings was growing, but the stock price was dead. Because
Mhm.
it takes a lot of earnings growth to come back to a decent PE ratio when you start at 75. So those are two examples, but there was a lot more than that. Right now, what we see is also a massive investment into the AI infrastructure. And this is where the parallel could be interesting for the bubble. While there was a big bubble built on the internet backbone, well, we have a similar story right now with data center, cloud services, power
Mhm.
grids to power those data centers that are required to compute all this AI. And this is where I'm saying we might have a bubble because if the money is not there at one point, we will have built like kind of like the at one point, I don't know if you remember, I think it was like maybe 10 years ago, but in China, they built those giant cities thinking we're going to build and they will come, but nobody ever came. And I don't know
Right.
what happened, but I did not follow up on that story. But back then, you had like cities that could welcome 10 million citizens and they were almost empty.
Mhm.
So spending massively is not necessarily a guarantee of making money down the road.
Okay, so Mike, how would you define the criteria for a tech stock to be immune to the AI bubble?
Using the word immune is probably a big word. Again, we always have to put everything into context, so don't go crazy on that. But more immune in the sense that it will not destroy them. Of course, we're talking about tech stocks that are linked to AI. If there's an AI bubble, they will take a hit. So don't I
Mhm.
mean don't buy Microsoft and the other three companies that we're gonna talk about today and think, oh, I'm going to buy Microsoft and it's never going to be down 20%. I mean, come on, use a little bit more context here. So, yes, they will take a hit, but because it's part of their valuation right now, the part of the narrative is like, hey, they're going to make even more money because they're AI, but there's a
Hmm.
lot more to it. So, I identified three factors. The first one, being a great company, a thriving company before 2023. So a company that shows great financial metrics, great growth vectors, and robust balance sheet way before AI came into the public. The number
Hmm.
two is to have other growth vectors. So sometimes I see companies that are literally being saved by this wave because now they're making a product, they're making something, but before that, they were not benefiting from any other tailwinds. And that definitely will kill a big part of their business if
Right.
there's a bubble. And finally, strong dividend triangle. I mean, we're going back again to the fundamentals here. So a business that between 2013 and 2023 saw the revenue growing constantly, earnings per share as well, and the ability to increase their dividend. And we're talking tech stock, so you can say 5% and more year after year for the past 10 years. So those factors, those metrics should be enough to say, well, if there's a bubble, yes, they will take a hit, but there's still hope that they will recover because they have a sound business model behind the business, not just a weak AI flag to wait.
All right, so let's put concrete examples to this, starting with Microsoft. What makes it interesting with and without AI?
So without AI, we're talking about a business that has strong bond with corporate America. So they sell subscription-based services with Windows, with Office, with Dynamics 365. They have this complete suite of software that many companies are using. And it's kind
Hmm.
of ironic because I keep reading that computers era is dead, and yet they're still making money with those operators. So I guess it could be interesting. Cloud with Azure, that was really strong way before AI. Right now, they're getting a boost for that. So that's for sure. But it was still growing 20, 30% year over year. So we're talking about something that, regardless of what's happening with artificial intelligence, more and more people are using cloud services for different purposes. So this will continue to grow. It's a lot smaller in terms of growth vector, but I still like their business segment around gaming. So they bought Activision Blizzard, they have Xbox, they're competing against Sony's PlayStation. I'm still a PlayStation guy though, but they are growing on that part as well. So that is the business without AI. So even if I just look at that part, probably the valuation would be a bit smaller right now, a bit lower,
Hmm.
but still a valid dividend grower moving forward. Now with AI, which is great, is you can see a natural integration into the software business. So just improving everything they do by adding AI. And this is what they're doing right now. So it's already new services, new ways to make money that they're creating. The boost from the need for more cloud services, as I just mentioned. So that is probably one of the most important part for Microsoft. And of course, they have strong relationship with OpenAI, the creator behind ChatGPT. While there's a lot of competition around language model and AI models, being a first mover is definitely a good advantage. And then Microsoft has kind of like their hands into everything that is opening over there. So it's a good relationship to have at this point. I'm more bullish about Microsoft than investing in OpenAI, even though it's not a public company. I would probably not invest in this one because they're going to have a hard time to find ways to be profitable, which is definitely not Microsoft's problem.
Right.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
Another good one is Broadcom, Avgo. Ticker is Avgo. You've been mentioning this one over and over again at Dividend Stocks Rock since I think it's around 2018. But why do you like it so much?
It's actually 2016. Can you imagine?
Ah. So it's
It
been
took me
10
almost,
years.
yeah, it took me almost 10 years to add it to my portfolio. Shame on me. Sometimes I have great ideas, but I have poor judgment, I guess, because I did not pull the trigger back then. But, anyways, that's another story. Semiconductor company with a great history of growth by acquisition. Ironically, and some people may wonder why Broadcom has a ticker that is AVGO. That doesn't
Mhm.
make much sense, right? AVGO versus Broadcom, but it's because it came from a merger between AVGO and Broadcom. So that's why they kept the name Broadcom, but they had the previous ticker. So that's the history behind it. They make a lot of acquisitions. They have great expertise with this. But keep in mind, before we continue, this one is a roller coaster. I remember in 2018, that's probably why you remember that date. They made the acquisition of CA. The market went ballistic. The stock lost 10% in a
Right.
single day after the announcement. That happened in 2018. It was at the beginning of this small bear market that happened for over like 6-7 months. But the market just couldn't understand why they would be making this acquisition. So sometimes you're going to have like violent reaction for Broadcom. So just be aware. It's normal, totally normal that this stock will jump or drop by 10% in a single day. Not too long ago in 23, if I remember correctly, they acquired VMware. It's a cloud software that they can integrate into their infrastructure and offer even more products. So that's a basic play for them to do is they have this wide product offering, and now by adding more competitors or different services, they can actually do cross-selling and improve what they already do. So those are the reason why I like Broadcom so much without even considering AI.
Okay, so now what makes it edged against an AI bubble?
Well, it met the three criteria that I talked before. One thing is their growth vectors by acquisition is like obvious. The other thing that I really like is the stability of income generating by their RF filters. So RF filters are improving connection within smartphones. So you can imagine that we're buying more and more smartphones. We need more connection. So it's kind of like a almost an essential part of their components of a phone. So they're making a lot of money there. And one thing that is great for them in terms of AI, but it's going to be good anyway, is their chips are helping computer calculate faster. So yes, it's crucial for AI because then you become more efficient. So that means that you can calculate more stuff faster at a lower cost. So this is again going back to the problem around the AI bubble is mostly about cost versus profitability. Well, Broadcom is participating in helping this problem. And at the end of the day, who doesn't want to have like faster calculation? That's if it's not AI, it's going to be something else, but we want to be more efficient, more productive. So there you go. Broadcom has just developed technology that will help companies and people to do that.
Another classic tech stock that could perform well despite an AI bubble is Apple. What makes it attractive in this context?
So what I love about Apple, still my largest position. I trimmed again. It's been the third or the fourth time actually that I had to sell some of my Apple shares because they become too big in my portfolio. Pretty good problem to have, so I'm super happy about it. The nature of the business has not changed that much over the past 10 years or more. It's their product ecosystem. It starts with the iPhone. It's still the key element here, but they're selling so many different other devices and services around it. And it's so easy to connect everything and make it work. It creates raving fans, which is even more important. I mean, you could believe that there's a limit of how many iPhones they can create and how many cameras they can add to the phone. And yet, iPhone 7, 17, sorry, not 7, is still selling super well. They're still super high demand. So I don't know. People don't get enough iPhone in their pockets. I cannot explain it, but it works, right? And that creates the fact that it has becomes this crazy cash flow making machine. It's literally just like spitting cash every single day, which is also another good problem to have as a business.
But Mike, aren't you concerned that Apple isn't getting into the AI wave enough, which may make its products irrelevant?
I'm actually annoyed about that because I am an Apple user, not for the Mac. Cannot get my head around working with a Mac. I prefer a PC, but for the phone, for my AirPods, and one thing, I'm just like, man, when I discuss anything with ChatGPT, it is not Siri. I can tell you that because Siri just has it has a hard time just to like pause or play a podcast while I run. It's just very annoying. Anyway, so not the smartest phone for a smartphone. We could put it that way. So it's kind of like ironic, but right now there is less hype around Apple that is led by the AI. And that probably is their biggest edge against a bubble. That could also become a problem if AI doesn't turn out to be a bubble and needs to and becomes to be critical, which is actually more my thinking. I see
Mhm.
the investment into artificial intelligence more as a macro play now because it drives a lot of investment across several services and industries. Back to Apple, I think that it's not the first time that they're late to a party.
Mm.
So they have their balance sheet and the cash flow generation ability to get back on track. They're not, I would not consider them for that yet. And they still can create a lot of partnerships or pay a steep price to buy an AI company and solve the problem. So they have a lot of solutions on the table for them. So I'm not really worried about them. If not, I would have trimmed even more of my position into Apple. It's still a risk, but I don't believe it's going to be a catastrophe for them over the long run.
Okay, so the last one to be discussed today is Alphabet, also pretty much known as Google. Why is it part of today's list?
Because I'm super excited to talk about it. I'm excited to be because I mean I recently entered into a position into Alphabet, so of course I'm all excited about it. But going back to numbers, I mean it started to pay a dividend not too long ago, so of
Mhm.
course you don't have a long dividend growth history. But if you look at the revenue growth, the earnings growth, the cash flow, all the metrics are growing at a super fast pace thanks to their dominant position in the search business. So search engine, they are dominant. In Google and YouTube, they're dominant as well, and they generate most of their revenue from advertising. So when you have those super important, I mean, vital platforms, we could put it that way, that everyone is using all the time, well, then you attract a lot of advertising money. I don't think that is going to slow down anytime soon. They also work on other growth vectors, such as Waymo self driving car, which
Hmm.
is really interesting here because there's also a link to artificial intelligence, obviously. So if they are able, and they're making great advancement there. So if they are able to make it a full business that is profitable, that could become a bigger story than YouTube actually. So that could be another huge home run for Alphabet. So for all of those reasons, and the one that is more important related to AI, it's the only vertically AI integrated stock that we have discussed today. And by that, I mean they make their own chips. So they do not rely on NVIDIA. They have their own TPUs that they use. And now they're thinking about maybe selling some of them or letting people use it through their data centers. So
Hmm.
they have the technology, then they have data centers, then they have cloud services, and they have developed a language model that has been my best friend as of late since Gemini 3 went out in, I think it's in December. I'm using more and more Gemini and Notebook LM that we just discussed right before we
Right.
recorded this episode. So, anyways, the language model is, I mean, at first it was a joke when they launched Bard, and we all remember that. This is how fast things evolve. But one key thing that Google has that many other companies, smaller AI players, doesn't is they can actually afford to burn an enormous amount of cash and
Hmm.
still be profitable anyway. So they're
Right.
not burning cash in the hope of becoming profitable. They're already very profitable, and now they can use that profit to create another growth vector. And the
Hmm.
fact that they depend less on anything versus any other AI players, that talks a lot about how strong Google has positioned themselves. And it was all planned. They saw themselves as the AI company before AI was a buzzword. So that came from a while ago. It took them time to get there. But now that I see the full picture, I was really excited by it. I may be late at the game, but I don't care because it's not my first time where I buy a stock that I called as being overpriced. We'll see if I'm right or wrong or in 5, 10 years, and I'll be happy to discuss it back then. But for now, super excited about Alphabet.
Okay, so Mike, if you had none of them in your portfolio, which one would you buy today and why?
Yeah, so full disclaimer, I own shares of all of them. So ends the question, right? I mean, we just ended the segment on Alphabet, and I think this one is my favorite at this point. My favorite play on AI, not probably the one that is the most immune. The best immune at this point, I think, is Apple. But I'm super happy because they're not necessarily the same type of investment from one to another, because we have Apple that is selling devices. We have Microsoft that is mostly a software business. We have Broadcom that is really a semiconductor. So it's really about chips. And then we have Alphabet that is making money from advertising. So it's actually labeled in the communication sector. So yes, it's a technology company, but they have also a different angle. And this is what I like about investing in the same sector, but in different industries. So I can make different types of plays, and hopefully they will all be good. But if not, I'm not buying 4 chip makers or 4 software makers. I'm trying to take my favorite company in each industry instead.
Right. And I think it's so ironic that Alphabet is still labeled as communication services, because to me it's no doubt a tech stock, that's for sure. But
But
anyway,
that comes from the fact, and it's a it's a very good point that you're making. But that comes from the fact that their business model right now, yes, they are able to be dominant thanks to technology, but their business model is about advertising.
right.
So it's a subtle difference, because without the technology, they would not have major search engine and they would not operate YouTube the way it is being operated. But without advertising revenue, they would not have a business at all.
Okay, so now, Mike, this AI macro trend has ripple effects on many things, and many of them are part of the investment themes for 2026. So listeners who would like to get more details can watch the webinar replay now for free at thedividendguyblog.com replay. But please give them a hint again of what they'll get.
So if you are on the sideline right now and you think that you're rather wait because of political tension, because of wars, because of tariffs, or whatever your hesitation is, and you're in freeze mode right now, this webinar is for you. I share actionable strategies with rationality behind it. So it's going to help you follow step by steps to get out of paralysis by analysis. I'm talking about exciting stocks, companies that I love, stock pick ideas. It's always interesting. And there is this private invitation for a webinar that is for DSR members only on a special workshop. So I will help members at DSR step by step diagnose all the potential weaknesses, find your blind spot in your portfolio, design your investment strategy, and then deploy a plan, an actionable plan in the next 90 days. So that's the private workshop that I discuss during the webinar, but you must be a DSR member. This content will never be published anywhere else. We're not going to talk about it in the podcast or in any other of my platform. So you want to get access to the workshop, the worksheet, and all the documents that will support you to do that reset in your portfolio, you must watch the webinar. So again, dividendguyblog.com/replay. Kind of easy to relate.
Well, thank you, Mike, for shedding some light, more light, I should say, on the AI bubble that is not quite a bubble yet. Let's keep that in mind. Listeners, remember to watch the webinar replay now at thedividendguyblog.com/replay. It won't stay available forever, by the way, so do not miss it. And for our show notes, visit thedividendguyblog.com/263. Do not miss an episode again. Hit the subscribe button underneath our podcast logo to get notified. And you may as well leave us a 5-star rating to let us know that you enjoy what we do. And until next week, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.